Welcome to the Life and Loans Podcast, where we explore the connection between your finances, your health, and everything in between. I'm Peter Soroder, a mortgage broker with over 2 decades of experience in the industry. Now, let's set the record straight. No, 6.1 million homeowners are not behind on their mortgage. This past weekend, a chart circulated all over the internet that said 6.1 million homeowners are currently delinquent on their mortgage and to brace for impact. Want to know the only problem with that? It's not true. The chart being shown actually refers to multi-unit properties of 5 units or more. Those fall in the category of commercial real estate. The commercial sector has been facing some challenges for several years now. When you combine the fact that the majority of them have adjustable rate mortgages, plus decreased occupancy, naturally, it's created some stress. Many of the companies that took out mortgages on these commercial properties are now dealing with decreased rent along with the increased cost of their mortgage loan. But here's the key point. This is not new information. The struggles in commercial real estate actually came to light back in 2023. And ironically, the very chart being shown actually shows exactly that. And for some reason, the doomsdayers decided to pull this out over the weekend and start scaring homeowners that there's a crash coming. Now, when looking at this chart that was shared over the weekend, I wanted you to notice a couple of things. First, it says clearly on there that it's for multifamily properties. Second, notice that it shot up vertical in 2023. So this is not an impending doomsday scenario where this is just happening as we speak right now. So in this podcast today, let's take a look at what happened in 2008 and compare it to today's borrower in 2025. In today's podcast, I'm going to ask you to do something a little bit different. I want you to think critically. Use your own logic when we go through this data and come up with your own conclusion about what's different with today's housing market. Today, we're going to come up with 3 main reasons why today's housing market is different than 2008. And on a side note, I have personal experience here because I was originating loans leading up to the great financial collapse, and I personally got caught up in a property when values crashed. So I understand the pain that many people experienced. The first reason why today's housing market is different than 2008 has to do with the ability to repay rules that were enacted after the great financial collapse. These rules require lenders to ensure that any borrower taking out a loan has the ability to repay that mortgage. That's done by verifying their income history over the past 2 years with very strict lending guidelines. Additionally, the mortgages that are done in today's world are by far and wide done with fixed rate mortgages. If you take a look at this chart here, this shows you the mortgage market composition by country. As you can see, the United States actually leads the entire world in fixed rate mortgages. We learned our lesson. We experienced what happened by doing all the adjustable rate mortgages, and we don't do those anymore. Take a look at this chart also. This shows adjustable rate mortgages by share of applications. As you can see, it's a very, very, very small number of loans that were done with adjustable rate mortgages. Now compare that in looking at what led up to the great financial collapse. As you can see, starting in 2004, we saw a very steep rise in the number of applications that were done with adjustable rate mortgages. Now my question for you to think about. With today's ability to repay standards, along with the fact that consumers have fixed rate mortgages, does that sound anything like 2008 to you, where people were qualified based on stated income and received adjustable rate mortgages? Number 2, borrowers are more qualified than ever. Take a look at this chart here. This shows the average credit scores for folks that are taking out mortgages in today's world. If you look at this here, you'll see that there's a large majority that are 760 plus. In fact, most of the loans originated today are for folks that have a 760 plus credit score. Now, on the inverse of that, look at the red bar. As you can see, leading up to the great financial collapse, we had a much higher percentage of folks that had credit scores that were below 620 and that were in that 620 to 659 range. Then look what happened after we learned our lesson. We have very, very few of those borrowers remaining, and the ones getting mortgages today are very well qualified. Also, in today's world, the vast majority of borrowers are putting a significant down payment. In fact, all buyers together average about 15% down payment. This is also a stark difference from 2008 when 100% financing was very, very common. And my last point of why borrowers are more qualified than ever. If you look at the loan to value ratio for mortgages that are outstanding in America today, you'll see that they're actually around 46% loan to value. And what that means is that the average person who has a mortgage today has over 50% equity in their property. Now, my question to you, if the average person who has a mortgage loan has over 50% equity built up in that property, does it sound logical to you that they would let that property go into foreclosure if they had a financial problem, or would they sell that property to get the proceeds? And for my third and final point, take a look at this here. Did you know that of every 5 properties in America, 2 of them don't even have a mortgage at all today? Just take a look at this chart here. We're showing almost 40% of homes do not have a mortgage on them at all, and they are free and clear. And finally, take a look at this chart here. The average person who does have a mortgage, this shows the range of rates that are outstanding on those mortgage loans. Over 50% of the outstanding loans today have an interest rate below 4%. That means that their housing cost is below what the rate of inflation has been. Now, my question to you, with so many Americans being locked into low interest rates and so many homes not having a mortgage at all, does it make sense to you that there would be another widespread foreclosure crisis? It's natural to let our past experience guide our outlook on life. Should we learn from them? Absolutely. But should we assume that the future will always mirror the past? No. That is where critical thinking comes in. We need to look at today's market with a clear lens, recognizing how the dynamics have changed, but also applying the lessons from the past. In the next episode, we're going to dive even deeper into that topic. I've spent years listening to people who have a negative outlook on nearly everything. They're not bad people. There's usually more to their story. Thanks for tuning in. If you found this helpful, please share it with a friend who might need some insights on what's happening in today's housing market. Look forward to seeing you next time.